I bet you didn't know this about CMHC. In today's video, we're going to break down some weird rules that CMHC has that you probably don't know. Hey guys, Josh and Aaron back for their Finance Friday, and in today's episode we are going to tell you weird CMHC rules that you don't know. Now, as many of you know, CMHC changes the rules often, and there are many of them to know. So to start off, the rule that I think is probably the weirdest and the one that I've actually seen come up more often than not recently would be mechanical rooms. So this is something that I guess has been around for a long time but hasn't necessarily been picked at by most CMHC underwriters until recently, predominantly in Alberta. But the rule is that CMHC requires that all units be completely separate. And what that means, there's part of the definition of a separate or separated unit where the mechanical room is required to be accessed by each individual unit or a central boiler room unit, kind of like a purpose-built multifamily building. What's happened is some developers or builders have made stacked units, and they've had shared mechanical rooms in single units that aren't necessarily accessible to all the other units, and CMHC is no longer allowing that. So this is a rule that has come into effect and is something that you should definitely be made aware of, especially if you're a new developer is looking to build something and take advantage of the increased densification rules.
Yeah, absolutely. The next one we want to talk about is getting into projects that have mixed use with commercial. So there's a few pieces to this one. First off, square footage wise, the commercial can't be greater than 30% of the overall square foot of the building. And then we can take that a little bit further. When we underwrite it on the mixed use, we actually have to break down the residential and the commercial components separately and underwrite each of those. So the underwritten value of the commercial piece, you can only go up to 75% of that value. So if we're running the numbers and your commercial piece comes out to $1 million, the max amount of loan that you can attribute is $755,000, so that's 75% there. And then the overall value can't be greater than 30% of the overall project value as well too. So there's a few different items there depending on the size of the building. I think most of the ones we see these days, especially in the newer age buildings, it's the square footage isn't that large, but some of the older the projects, or if you're seeing some of these Costco up-down type buildings that are getting built down the States, that might push the square footage. But those are the CMHC rules surrounding mixed use properties.
Yeah, one of my favorite rules actually came out last year, and it provided guidance around the difference between pre-existing and new construction. So the classification that CMHC has for a pre-existing building is that you built off of or are using any aspect of a pre-existing building, very self-explanatory. But for new construction, what was happening is developers were demolishing, let's say, 2 or 3 walls, and they were building off on top of or around a pre-existing building. And for a long time, they were trying to get away with it being new construction, and then using the classification of new construction to get better insurance flexibilities and benefits. Well, CMHC came out and they made a very clear definition that if any of a pre-existing building, any brick, any wall, any aspect of a pre-existing building is used, even on a new development, that CMHC will classify that specific development as pre-existing and not new construction. So if you're getting into building a property and you want to use the same footprint, and maybe there's a wall that you want to use, it's really important to understand the difference between the two, because it could be the difference between you getting 95% on your total cost of your project and 85% of the value of your project, and the point distributions on both energy efficiency and affordability drastically change. So that's something that is kind of a sleeper cell that most people should know when they're getting into that missing middle development.
Yeah, and I think just to add on to that, that does not include complete change of use. So if you have a hotel or an office building and you're not changing the structure, but you're changing the use of it to a res or mixed use, that would still classify as new construction. But straight additions with fully res, yeah, not going to be considered that. I think continuing on with somewhat recent changes, and one of them that I think impacted a lot of individuals in the Alberta area is obviously rule policy changes around the amount of units aggregate to be able to be considered as multifamily with that 5 minimum. So no longer can you take 2 separate titles and collateralize a loan across them to hit your 5 units. So we were seeing a lot of single-family townhomes that were just bundled together on 5 different lots, trying to get a collateralized loan, calling it 5 units for multifamily. Or one that I don't necessarily agree with, but we also saw the rule change, was 2 side-by-side fourplexes or triplexes. Again, separate lots, separate titles, collateralizing a loan on there to be able to hit that 5 unit minimum. Those are no longer viable projects. Everything does have to be on one complete lot, or the building has to be connected, traversing those 2 titles.
Yeah, great point. Adding on to that, something that a lot of people don't know is when they are looking at underwriting their file, CMHC looks at it a little bit different than what they look at it. So if a realtor or a developer is providing a pro forma to a client, and that has your management, your maintenance, your vacancy, odds are that they are not following CMHC's benchmark expenses. Now CMHC has these internal expenses that they use on a per unit basis to underwrite your file, and that essentially what they do is they use additional expenses than what you would normally use on regular underwriting. And what that does is it actually drives your net operating income lower, which inevitably will drive the value lower if you're using the same cap rate as your appraiser. So usually what they'll do is they'll either use the lower of the net operating income through either appraisal or them internally with their benchmarks. So just keep in mind that CMHC as a rule will use their own internal underwriting in addition to using some of the expenses provided by the appraiser.
Yeah, and if you're buying a building or obviously doing some sort of development, just ensure your appraiser is actually using CMHC benchmark expenses in how your broker and CMHC is going to underwrite, because it will, like Josh said, drastically change. So your building value might come in, but when CMHC underwrites it and we underwrite it to CMHC expenses, your building value might actually be below. And you might actually have to inject a bit more capital into there for the equity position. So just keep that in mind. Another somewhat recent policy change is surrounding net worth and how CMHC is qualifying. This one becomes a bit more of an issue for investors who have a larger portfolio, especially that portfolio is not owned in their own personal name. When you're qualifying for CMHC, obviously we know there's a 25% net worth requirement based on your loan size. The net worth now has to be taken directly from the involved guarantors in the project. So, direct borrowers who are guarantors on the company, or the company itself that's actually doing and transacting as the borrower. Now, obviously, we've seen investors who like to buy in multiple different holding companies. If this is the situation that you are in and your net worth is all tied up in an additional holding company, chances are that corporation is going to have to come on and provide a guarantee to be able to allow you to hit your net worth. So just keep that in mind.
Yeah, no, obviously, important to note. Last but not least, something that just came up in the last advice that was provided is rental achievement holdback for the MLI Select program. So if you are a developer or you have a project that have submitted your file, or you're getting construction financing, CMHC now requires something called rental achievement holdback for usually larger projects. And essentially what this does is they are going to hold back a percentage of the construction financing that they've provided for you, usually at 75% loan to value or loan to cost, whereas you were qualifying for 95%. That 20% buffer, odds are they're going to hold that back and have you finish the project, lease up the property, and when you can prove that you have hit the effective gross income target that you submitted the file at, they will provide you the top up or the rest of your loan. Now this is, I assume this is due to market changes and sometimes drastic market changes. We've seen rents soften in certain areas, and what this does is it insulates the lender and allows them to require the borrower to have additional liquidity or strength to get the project across the finish line.
Yeah, obviously it's a big hit to your equity. If you're expecting to put 5-10% down, all of a sudden you have to be able to inject 25%. There are some of these CMHC lenders that do recognize that, and if you can prove overall strong enough borrower guaranteed experience, some of these lenders will actually put in a second position piece in behind up to 85%. It is as a true second, so you are paying second position like interest rates 11-12% plus fees, but for those on the larger projects, sometimes that 10% can be millions of dollars and not just a couple $100,000. So again, there are some options depending on the situation to help bump that up on a mezz loan.
Yeah, no, all great points. I think, there are probably 1,000 other rules that we could go over, but these are the ones that we thought were most pertinent to you guys right now. If you guys liked this video or you thought this was interesting, Erin and I have actually shot probably 100 videos on this topic. So if you are interested in watching or learning more in depth about the things we just spoke about, there's going to be a box down below that you can click on some of the videos that we previously shot, and you can dig into what that looks like. Now, if you have any questions about that, there's some contact information down below for both Erin and myself. Feel free to contact us. We'd love to be able to chat and have a conversation with you about it. If you did like this video, please hit the subscribe button, hit the like button. It allows both of us to do this, to send more content to you guys. Really appreciate you taking the time.